With a brand new tax year in the UK comes a whole load of brand new tax-free allowances that we can try and utilise across the tax year, which runs from the 6th of April to the 5th of April every 12 months. In this video, we're going to go through 9 tax-free allowances which hopefully you can utilise this tax year. So the more we can take advantage of these allowances, the better. And a lot of them, probably most of them, are either use or lose. Anything you don't use in any tax year is lost, which is why it's important to try and make the most of it each tax year. Said tax year quite a lot in that intro just then. We're first of all going to start off with a few investing allowances, get into other allowances for your children, and then just a few sort of random ones that are also worth taking a look at, and hopefully you'll be able to use up this tax year. Said it again. I will leave the timestamps in the description below if you want to jump in between any of the different tax allowances, or if you watch the video through and want to jump back and rewatch another part of the video, you can find the timestamps easily in the description. So first of all, let's start off with investing, and there are a few different tax allowances we can use here. Number one, very important one, the ISA Allowance. We get a £20,000 ISA allowance each tax year, which can be used across the 4 different types of ISA: cash, lifetime, stocks and shares, and innovative. Importantly though, with the second one I mentioned, the lifetime ISA, you can only contribute £4,000 into a lifetime ISA each tax year, and that comes out of your £20,000 overall ISA allowance. So if you put £4,000 into a lifetime ISA today, you therefore only have £16,000 of that ISA allowance left, which you can use across cash ISAs, stocks and shares ISAs, and innovative ISAs. So for me personally, I mainly use my ISA allowance to contribute to my stocks and shares ISA. So that's money I'm putting away every month, investing for the long term. Cash ISAs, which haven't really been spoke about much in really like a decade, just because the rates have been terrible, because interest rates have been so low, now are offering slightly more attractive rates. To be honest with you, it's still probably easier to use an easy access account, so you can get a similar rate and access the money instantly, whereas with cash ISAs, you normally have to lock the money up for 1 year, 2 years, 5 years, whatever it is. But this tax year can be worth looking into, if particularly the rates keep going up. Finally, innovative ISAs are for peer-to-peer lending. I personally never use them, but with peer-to-peer lending, it's a bit more risky, but you can earn higher rates of interest, or higher rates of return, I should say, because ultimately you're giving your money to someone and they're going to probably use it to invest into something and then pay you back a fixed percentage over the term of that peer-to-peer loan, so to speak. Number 2 is the Pension Allowance, which, good news, has gone up this year to £60,000. It was previously £40,000. It now increased by 50% to £60,000. That is a serious amount of money to contribute into a pension. If you're going to contribute the full 60k, you will probably need a multiple 6-figure salary. So it's out of touch for the larger majority of us, but it's still worth mentioning. Pensions are great because you can avoid some income tax today. That money then grows tax-free over the years, and then when it comes to actually drawing down on it, even though you may have to pay tax, there are tax efficient ways to draw down on it when you get there. But a key point with pensions is we get some tax relief today, and you could also get an employer match, which essentially is free money, which doubles how much is going into your pension and double the amount of money they're going to compound over the long term. Whereas the ISA allowance is use or lose, with the pension allowance you actually can make use of the previous 3 years allowance. So you could, if you wanted to, contribute 6 figures plus into your pension to make use of previous allowances. But in each tax year, from going forward from now anyway, we get a brand new £60,000 pension allowance. Now, number 3 and 4 here, unfortunately, have been cut in half. So the CGT, the capital gains tax allowance, which was previously £12,300, as of this tax year is now only £6,000. So you pay CGT on things such as if you sell any stocks or shares outside of a pension or an ISA, if you sell any crypto, so essentially anything in a general investment account that you sell is going to incur capital gains tax. If you sell a second property or a rental property, that's going to incur capital gains tax. Whereas previously the allowance was 12.3k, it's now only 6k, but it's pretty sad that it's been cut in half, to be honest with you. It's one way the government are trying to, I guess, tax us more, recuperate all of their spending, particularly through the COVID pandemic. But in this tax year, it's still worth trying to make use of that full allowance if you're able to. To a similar tune, and perhaps more brutal, and this impacts more people, I would imagine, is the Dividend Allowance, which was previously £2,000. It actually used to be, I think, £5,000. Then it got cut to £2,000. And now from this tax year, it's getting cut to £1,000.
Are you serious?
So once again, you pay dividends tax on any dividends that are outside of an ISA or a pension, so any general investment accounts that you hold. If you earn dividends of more than £1,000 in that general investment account, which is outside of an ISA or a pension, you will pay dividend tax. Also, and perhaps more damning, is that people who maybe have a company who pay themselves dividends, their allowance is now only £1,000. You're going to start paying dividend tax much earlier. What's even worse is the CGT and the dividend allowances are getting cut in half again from the next tax year. So it's going to get worse, unfortunately, and we're going to pay more tax next tax year. So if you can use these two allowances this tax year, definitely make the most of it. I know for me personally, I always try and make use of the dividend allowance when I pay myself a dividend from my company. So I'll be using that £1,000 allowance at some point this tax year. So there are 4 investing allowances to be aware of. Let's quickly jump into a couple of allowances you can use if you have children. I don't have children. I imagine a lot of people watching this don't have children, but it's still good to be aware of this. Maybe you can spread this knowledge to a niece or a nephew, someone, one of your mates who's having children, whatever. There's 2 allowances here we're going to talk through, which even if you don't need them right now, it's good to be aware of, and perhaps you can spread this knowledge to other people. Number 1 is the junior ISA. So just like we get an adult stocks and shares ISA, you can get a child's junior ISA. And just like adults, this can be used for a cash junior ISA or a stocks and shares junior ISA. And the allowance on this is £9,000 per tax year. So it's pretty generous. So you can invest nearly £1,000 a month for your child into a junior ISA to make use of this full allowance. For me personally, as the child is not going to need that money, hopefully for decades, or if they're 18 and are now 18 years at least, I would say it's probably best to put that money into a junior stocks and shares ISA, just so that money can compound over the long term. When I use that money at 18 for, I don't know, uni, or for 25 for a house or car, whatever it is, hopefully by using that junior stocks and shares ISA, that money would have compounded to not only beat inflation, but generate some sort of decent return over the decade or 2 that that's been invested for. The second child's allowance we're going to talk about here now is the junior SIP. Just like adults get a pension allowance, children also get a pension allowance of a junior SIP. It's only £3,600, but once again, that can be used to essentially invest for the long term, and realistically, that SIP is going to be compounding for 55, 60 years. So even sticking away tenner, 100 quid into one of these SIPs, hopefully over the super long term or 50 plus years, can generate a decent return and be a nice little pot for your child one day, once they're obviously an adult and I guess have retired by that point. Out of these 2, I would generally say the junior stocks and shares ISA is better. It's more flexible, you can access the money sooner, and the allowance is also higher. And also with stocks and shares ISAs, you generally get more choice and autonomy of what you can invest into, and reduce your fees, so more money is kept in your own pocket, or in your child's pocket, or niece's or nephew's pocket, or whoever's pocket you're investing for. So that is 6 allowances covered so far. We got 3 left, and these are sort of just other allowances that are common and good to be aware of. The first one being the personal allowance, probably the one most people are familiar with. It's currently £12,570. So any earnings under that, you don't pay any income tax or national insurance. It's worth pointing out now that the income tax and national insurance bands are the same. Previously, I think NI was a bit lower, but now the actual bands where you start paying income tax and NI are the same, even though the actual tax rates you pay are different. So if you earn over £12,570, you're going to start paying 20% income tax and 12% national insurance. So the actual percentage taxes you pay are different. The actual allowance threshold is now the same, which I think makes it easier in terms of calculating what tax is due. If you earn, say, £20,000, if you do £20,000 minus the allowance of £12,570, you're essentially going to pay 32%, 20% income tax, and 12% national insurance on that amount. It's also worth saying this allowance has been frozen until 2028, and I think some other allowances have also been frozen until 2028, which is actually pretty terrible for us. Once again, it's a stealth tax, because as inflation is going up, these allowances should be going up, but they're not going up because they're being frozen for another 5 years. So it's another way we're going to pay more tax over the next 5 years, as these thresholds are not increasing with inflation like they should be. Number 7 of this is the inheritance tax allowance, which is £3,000. Essentially, you can give £3,000 of gifts or cash away to one person or various people in a tax year, and that £3,000 will not be liable for inheritance tax. I won't get too into inheritance tax. It's quite complicated, and most people will actually never pay it because there are some pretty large nil rate bans and other bans and allowances you get when you unfortunately do die, as morbid as that is. So most people won't actually pay any inheritance tax. Once again, it's just a good thing to be aware of. And finally, number 9, this is probably actually an important one, particularly as interest rates are going up. It's the Savings Allowance. So if you're a basic rate taxpayer, you get a £1,000 saving allowance. If you're a high rate taxpayer, you get a £500 savings allowance. And if you're a high rate taxpayer, then you get 0 savings allowance because you already earn a load of money, so you don't really need it. This allowance, once again, has pretty much been a non-factor for probably 10, 15 years, just because interest rates have been so low. So you would have needed a serious amount of money, 6 figures plus, to actually start paying any savings income. Now with interest rates increasing over the last 12 months or so, it's now much more likely that you could be due to pay some tax on the interest that you're earning on your savings. For example, let's say you earn £30,000 and to keep it simple, have £50,000 in savings. You know, you've been saving for a house for years, got some money from your parents, whatever. You have 50k in savings. You can probably now earn about 3% on that money, easy access. 3% on 50k across the whole year is actually £1,500. So that £1,000 saving allowance that you get as a basic rate taxpayer is going to be used up, and on that £500 you're then going to be due to pay some tax. So it's just something to be aware of this year, particularly as interest rates are going up. Your interest may become taxable if it's above those limits that I mentioned. And that wraps up this video. So there are 9 tax allowances that hopefully you can try and use up this tax year. A lot of them are use or lose, so do your best to use as much as you can. Of course, a lot of these allowances are very, very large. The £20,000 ISA allowance, the £60,000 pension allowance, just to name 2. I've never maxed those out and really never got that close to maxing them out. So don't feel disheartened if you don't get anywhere near them. The more we can actually use, the better, of course. So anything you can do to contribute to use these, the better. Thank you very much for watching. Hope you enjoyed. Make sure to hit the like button and I'll see you in the next video.